Hello everyone, welcome to the 57th episode of me learning how to trade in Forex. So in the last video we went through the basic Japanese candlestick patterns. We met the spinning top, the Marubozu, and then we also met the four dojis. There's some situations regarding if the candlestick before the doji or after the doji or something like that. And then now we're currently on single candlesticks patterns. So let's get started. Single candlestick patterns. Date is 26th. 20. Oh my god. Like that. Cool. So, single candlestick patterns. Now that you're familiar with basic candlestick patterns like spinning tops, Marubozus and dojis, let's learn how to recognize single candlestick patterns. When these types of candlesticks appear on a chart, they can signal potential market reversals. Here are four basic Japanese candlestick patterns. Hammer and hanging man. The hammer and hanging man look exactly alike but have totally different meanings depending on the past price action. Both have cute little bodies, black or white, long lower shadows, and short or absent upper shadows. So, hammer and hanging man. So hammer's here, hanging man's at the top like that. I wonder if that's what they called it in a previous lesson. There's a shorts and then inverted hammers, and they called it shooting star. Hammer and inverted hammers. So hammer and hanging man. I think this image probably does better than me just writing loads of words for it, so let's take this in. Hammer and hanging man. The hammer is a bullish reversal pattern that forms during a downtrend. So this is the hammer. Oh yeah, it says hammer here. It is named because the market is hammering out to bottom. Hammer, bullish reversal pattern that forms during a downtrend. Named because the market is hammering out the bottom. A bottom. When the price is falling, hammers signal that the bottom is near and price will start rising again. Price is falling. Hammers signal that the bottom is near and the price will start rising again. The long lower shadow indicates that the sellers push prices lower, but buyers were able to overcome this selling pressure and closed near the open. So the long lower shadow indicates that sellers were pushing the price lower, but buyers were able to overcome the selling pressure and closed near the open. Just because you see a hammer form in downtrend doesn't mean you automatically place a buy order. don't automatically place a buy order just because a hammer appears. More bullish confirmation is needed before it's safe to pull the trigger. More bullish confirmation is needed. A typical example of confirmation will be to wait for a white candlestick to close above the open to the right side of the hammer. Would be to wait for a white candlestick to close above the open to the right side of the hammer. Typical confirmation includes waiting for a white candlestick to close above the opening price to the right side of the hammer. Recognition criteria for a hammer. The long shadow is about 2 or 3 times the real body. A hammer is recognized by the long shadow being 2 or 3 times the size of the body. Little or no upper shadow. The real body is at the upper end of the trading range. The body is at the upper end of the trading range. The color of the real body is not important. Color of body is not important. The hanging man is a bearish reversal pattern that can also mark a top or strong resistance level. So, hanging man. Bearish reversal pattern. That forms during an uptrend. When the price is rising, hanging man indicates that sellers are beginning to outnumber buyers, and can also mark a top or strong resistance level. So if there's more sellers than the buyers, then the price is going to drop, right? Because, well, there's more people selling it than buying it, so the price is going to drop. And it does, so you get an uptrend here and then it goes down. So the lower shadow shows that sellers pushed prices lower during the session. Buyers were able to push the price back up some, but only near the open. Buyers were able to push the price back up, but only near the opening price. This should set off alarm, since this tells us that there are no buyers left to provide the necessary momentum to keep raising the price. Showing there's no more buyers left to provide the necessary momentum to keep raising the price. Recognition criteria for a hanging man. A hanging man is recognized by a long lower shadow, a long lower shadow, which is about long lower shadow 2 to 3 times the real body, being 2 or 3 times the size of the body, little or no upper shadow, the body is at the upper ends of the trading range, the colour of the body is not really important. What have I written there? Colour of body is not important, but a black body is more bearish than a white body, because a black body means the closing price is below the opening price. Because the closing price is lower than an opening price, there's a downtrend beginning to form, right? Because the price is dropping. Hence the bearish, I'm assuming. Inverted hammer and shooting star. Here we go. Inverted hammer and shooting star. So inverted hammer and shooting star. Inverted hammer. Inverted hammer and shooting star also look identical. The only difference between them is whether you're in a downtrend or an uptrend. An inverted hammer is a bullish reversal candlestick. Bullish reversal pattern. You're in downtrend or uptrend. A shooting star is a bearish reversal candlestick. Shooting star, it's the bearish reversal pattern. Both candlesticks have petite little bodies, filled or hollow, long upper shadows and small absent lower shadows. So inverted hammer is recognized by the long shadow being 2 or 3 times the size of the body, little or no lower shadow, the body is at the lower end of the trading range, color of body is not important. Same with the shooting star. Shooting star is recognized by the long shadow being 2 or 3 times the size of the body, little or no lower shadow, the body is at the lower end of the trading range, color of body is not important. Okay, so Inverted hammer. The inverted hammer occurs when the price has been falling, suggests the possibility of a reversal that forms during a downtrend. Its long upper shadow shows the buyers try to bid the prices higher. The long upper shadow shows the buyers tried to bid the price higher. However, sellers saw what the buyers were doing and said, "Oh heck no," and attempted to push the price back down. Sellers saw what the buyers were doing and push the price back down. Fortunately, the buyers had eaten enough of their Wheaties for breakfast and still managed to close position near the open. Close the session near the open. Buyers still closed the position near the opening price. Since the sellers weren't able to close the price any lower, this is a good indication that everybody who wants to sell has already sold. Since the sellers weren't able to close the price any lower, it shows that everybody who wants to sell has already sold. And there are no more sellers who are left buyers, leaving only buyers left. Oh, so if there's no more, that means if it's supply and demand terms, that means the supply has gone, but there's still an increased demand for it, so the price is obviously going to rise. Hence, the price rising here. It's a bullish reversal. Ah, right, okay. Okay, I see. So, prices rise as... Okay, makes sense. Shooting star. That forms during an uptrend. Shape indicates that the price opened its low, rallied but pulled back down at the bottom. The price opened at its low, rallied but pulled back to the bottom, meaning buyers attempted to push the price up, but sellers overpowered them. Therefore, no more buyers left. So if there's no more buyers left, but then there's still loads of sellers, that means there's more supply than demand, so the price is gonna lower. Hence, the reversal of an uptrend, leaving it downtrend. So price drops. Cool. Makes sense. Dual candlestick patterns. Dual candlestick patterns. What's better than a single candlestick patterns? Dual candlestick patterns. To identify dual candlestick Japanese candlestick patterns, you need to look for specific formations that consist of 2 candlesticks in total. Engulfing candles. There are 2 types of engulfing candles: bullish engulfing and bearish engulfing. Bullish engulfing candles. Okay, dual candlestick patterns consists of 2 candlesticks in total. Cool. Dual bullish engulfing candles. Bearish engulfing as well. So let me try bearish engulfing candles. Boom, 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 boom. Okay. Bullish engulfing. The bullish engulfing pattern is a 2 candlestick reversal pattern that signals a strong up move may occur. A reversal pattern which signals a strong up move could occur. It happens when a bearish candle is immediately followed by a larger bullish candle. Could happen. Occurs when a bearish candle is immediately followed up by a larger bullish candle. So we can see the bear candle here and the bull candle here. Here's a larger one than that one. The second candle engulfs the bearish candle. Right, okay. This second candle engulfs the bearish candle. This means buyers are flexing their muscles and that there could be a strong up move after a recent downtrend or a period of consolidation. On the other hand, the bearish engulfing pattern is the opposite of the bullish pattern. So, a reversal pattern which signals a strong down move, which signals could happen, occurs when a bullish candle is immediately followed up. Oh, that's horrible. Followed up by a larger bearish candle. This second candle engulfs the bullish candle. This means that sellers overpower the buyers, meaning buyers are overpowering the sellers. So meaning sellers are overpowering the buyers. If sellers are overpowering the buyers, that means there's more sellers than buyers, meaning there's more supply than demand. So if there's more supply than demand, then the price drops. Whereas the opposite one, the bullish engulfing candles, if there's more buyers than sellers, then demand is more than supply, so the price increases, hence which is shown here when it goes upwards. Okay, so that makes sense. Tweezer bottoms and tops. Tweezer bottom, tweezer top. Right, that's a nice tweezer here. Tweezer has a 2 candlestick reversal patterns, so it's still reversal. A reversal pattern, a reversal pattern. So this type of candlestick pattern is usually spotted after an extended uptrend or downtrend, indicating that reversal will soon occur. So let me just do this like that. Go before here, so it's easy to know. So 49.99. Tweezer bottom. This type of candlestick is usually spotted. After an extended downtrend, usually spotted after an extended uptrend. Notice how the candlestick formation looks just like a pair of tweezers. Oh right, I see. So you got that, and then these two things are these two things. Right, okay. The most effective tweezers have the following characteristics. The first candlestick is the same as the overall trend. If the price is moving up, then the first candle should be bullish. The second candlestick is opposite the overall trend. If the price is moving up, then the second candle should be bearish. The shadows of the candlestick should be of equal or near equal length. Tweezer tops should have the same height, while tweezer bottoms should have the same lows. Tweezers are recognized by the first candlestick being the same as the overall trend if the price is moving up. The first candle should be bullish. The second candlestick is the opposite of the first. If the price is moving up, the second candle should be bearish. The shadows of the candlestick should be near the same length. Tweezer tops should have the same highs, and tweezer bottoms should have the same lows. Triple candlestick pattern. So triple candlestick. What? Candlestick pattern. What's better than dual candlestick patterns? Triple candlestick patterns. To identify triple candlestick Japanese candlestick patterns, you need to look for specific formations that consist of 3 candlesticks in total. Yep. So triple candlestick patterns consists of 3 candlesticks in total. These candlestick formations help traders determine how the price is likely to behave next. Helps traders to determine what's likely to happen next. The price is likely to behave next. Some 3 candlestick patterns are reversal patterns, which signals the end of a current trend and start of a new trend in the opposite direction, and other 3 candlestick patterns are continuation patterns, which signals a pause and then continuation of the current trends. Let's take a look at the popular triple Japanese candlestick patterns. Evening and morning stars. Let's take a photo of this. That's morning stars, evening stars. The morning star and evening star triple candlestick patterns that you can usually find at the end of a trend. They are reversal patterns that can be recognized through 3 characteristics. So a reversal pattern, a reversal pattern. We'll use the evening star pattern on the right as an example of what you may see. Usually found at the end of a trend. Usually found at the end of a trend. The first candlestick is a bullish candlestick, evening star, so first candlestick is a bullish candle, which is part of a recent uptrend, part of a recent uptrend. Second candlestick has a small body. Second candle has a small body, indicating that there could be some indecision in the market, showing indecision in the market. This candle can either be bullish or bearish. Can either be bullish or bearish. Third candlestick acts as a confirmation that a reversal is in place, as the candlestick closes beyond the midpoint of the first candlestick. Closes, so in this one, the closing one is on the bottom one, isn't it? Yeah, below the opening price, so this one closes beyond the midpoint of the first candlestick. So midpoint's here, it closes beyond that. I don't like how they worded it as beyond, because beyond as in like what, lower? I'm assuming it means lower, right? Because it's lower than the midpoint here, so should be lower, yeah. Same for the morning stars. First candlestick is a bearish candle, parts of the recent uptrend. Don't know why there's no spell check anymore. Second candlestick has a small body showing indecision in the market, can either be bullish or bearish. Third candlestick acts as a confirmation that a reversal is in place, as the candlestick closes beyond the midpoint of the first candlestick. Cool. 3 white soldiers and black crows, and 3 black crows. So grab this one here. 3 white soldiers and 3 black crows. The 3 white soldiers pattern is formed when 3 long bullish candles follow a downtrend, signaling a reversal has occurred. So a reversal pattern follow a downtrend, usually found at the end of a downtrend. Signaling reversals occurred. A reversal pattern usually found at the end of a downtrend. Formed by 3 bullish candles. 3 long bullish candles. This type of triple candlestick pattern is considered as one of the most potent in-your-face bullish signals, especially when it occurs after an extended downtrend and a short period of consolidation. The first of the 3 soldiers is called the reversal candle. It either ends the downtrend or implies that a period of consolidation that followed the downtrend is over. First candlestick is called the reversal candle. Either ends the downtrend or implies that the period of consolidation that follows the downtrend is over. Second candlestick should be bigger than the first candlestick's body. Also, the second candlestick should close near its high. Should also close near its high, leaving a small or non-existent upper wick, or upper shadow as they like to call it in this paragraph. For the 3 white soldiers pattern to be completed, third candlestick should be at least the same size as the second candle and have small or no shadow. So barely any shadow seen here. There's no shadow on that one at all. The 3 black crows candlestick pattern is just the opposite of the 3 white soldiers. Right, okay, so a reversal pattern usually found at the end of an uptrend, formed by 3 long bearish candles. First candlestick is called the reversal candle. Either ends the uptrend or implies that the period of consolidation that follows the uptrend is over. Second candlestick should be bigger than the first candlestick's body. It should also close near its low, right? Should close near its low, leaving a small or non-existent lower wick. Third candlestick should be at least the same size as the second candle and have small or no shadow. Second should also close near its low, leaving a small or non-existent upper wick. Yeah, that's right. Yeah. Formed when uptrend indicating that reversal. Close very near its low. Yep. Very short or no lower shadow. Lower. Let me just be upper then. For the 3 black crow patterns to be completed, the last candlestick should be at least the same size as the second candle, but have small or low shadow. Yep. 3 inside, up and down. So copy. Three inside up, 3 inside down. The 3 inside up candlestick formation is a trend reversal pattern that is found at the bottom of a downtrend. A reversal pattern found at the bottom of a downtrend. A reversal pattern found at the top of an uptrend, I'm guessing. This triple candlestick pattern indicates that a downtrend is possibly over and that a new uptrend has started. Indicates that the downtrend is possibly over and a new uptrend has started. So this one indicates that the uptrend is possibly over and a new downtrend has started. For a valid 3 inside up candlestick formation, look for these properties. The first, not the first, I should call it the first candlestick should be found at the bottom of a downtrend and has a long bearish candlestick. Second candle should at least make it up all the way to the midpoint of the first candle. Should at least make it up all the way to the midpoint of the first candle. So yep, it does make it up. So the midway's here, the second candle's about here, so it does, yep. Third candle needs to close above the first candle's high. To confirm that the buyers have overpowered the strength of the downtrend. So the third candle needs to close above the first candle's high. So here, this is the closing price of the white one, right? So the white one is that bit there. So the closing price is here. The first candle's high is here, so it closed above that, yep. So the buyers have overpowered the strength of the downtrend. Conversely, the 3 inside down candlestick formation is found, so it's all the opposite. So first candlestick should be found at the top of an uptrend and has a long bullish candlestick. Second candle should at least make it up all the way to the midpoint of the first candle. Third candle needs to close below the first candle's low to confirm that the sellers have overpowered the strength of the uptrend. Right, third candle needs to close, so the closing price is for a black one it's below, so close below the first candle's low. First candle's low is here, and it has closed below there to confirm the sellers have overpowered the strength of downtrend, uptrend, yep. Close below the first candle's low. Close below the first candle's low, yep. Midpoint, yep. Uptrend, long bullish candlestick. Uptrend, long bullish candles. Bullish. There we go. Cool. That's done. I'm going to leave this episode here. So in the next episode we're going to cover Japanese candlestick cheat sheet, which I'm assuming is going to be like a summary of all the things we've done. But yeah, so thank you guys for watching, and I will see you then. Peace.